Welcome to the Legacy Leaders Podcast. Are you doing the best for your client to help them create their legacy? Are you creating a plan that goes far beyond finances to help people ensure that it becomes the driving force behind all decisions? On this podcast, hosts Katie Beth and Stan Miller will help you with growing your practice and your clients' peace of mind. Together, they bring the best and brightest minds to share with you how to help your clients develop their best legacy. And now, here are your hosts, Katie Beth and Stan.
Welcome to the Legacy Leaders Podcast with your host, Stan Miller and Katie Beth. Today, we are joined by the co-founder of the Momentum Wealth Fund, Guy Varble. Guy, thank you so much for joining us. We are really excited to have you on the show.
Well, thank you for having me, and thank you for letting me be able to share some things that we're passionate about, that we love about what we do, and hopefully be of value to both of the two of you as well as the group of people that you connect with.
Fantastic. So before we dive right in with our questions, and as you know from the talk before we started the show, we have many. But before we dive in, I was hoping you could take maybe just a few minutes and tell us, you're in a really unique industry. So tell us a little bit about your background and what kind of led you into this industry you work in.
Sure. So I lived in California, have my undergraduate degree in economics and business, worked for Procter & Gamble. They helped me get my MBA at Pepperdine in California. Finished that, became a banker. And so when I was a banker, I got exposed to multiple types of businesses, right? Some that were maybe less risky than others. And the one thing that I realized as a banker is that the painter or plumber who was going to retire, when they were going to retire, the one who owned the land retired with a lot more money. It was startling to me to realize that. And so we've been married 26 years. Our kids are 18, 19, and 21. And we moved to Iowa 21 years ago to be close to my wife's family. And it's been wonderful, but a wonderful blessing to be close to her parents and to live in community. And we live really close to each other, within 2 blocks of each other. And we get together every Friday night for 20 years. And so that process that brought me to Iowa got me thinking about real estate investing. We bought a program, how to flip houses in 2010, bought a bunch of rental properties, and then ended up getting into self-storage in 2018. So I think the combination of my banking, my finance, my education, and all of those experience, when I really got to understand the value that can be created in the self-storage industry, we decided to sell off everything else. So last year we sold off our last single family rental, and we are 100% into self-storage, and it is boring and exciting all at the same time.
I'm going to guess with storage, you receive a lot fewer middle of the night phone calls than you might on other types of properties.
Well, of course. And that's partly one of the things I didn't like about residential is the call you get on Thanksgiving, hey, my heater's not working. Well, in Iowa on Thanksgiving, that's a problem, right? You have to deal with that. The issues, they still exist in self-storage, but when you have a larger portfolio and you have facility managers who handle all of that stuff, you're not the one getting those calls. You have a group of people who are professional and great at what they do, and they want to be great at what they do. And I think that's a key factor, because I honestly don't want to be great at managing the facilities day to day. I'm good at it. We know how to do it. But I don't want to be great at that. That's not something I personally want to be great at.
What types of things do you look for when you're looking for someone to hire for a facility manager, for somebody on your team? What types of qualities do you look for? What are some qualities that you don't want them to have? Tell us about the wisdom and experience you've gotten from that process.
Yeah, so we'll separate them two. One is on the team that I work with every day. These are the underwriting team, the finance team, the equity raise group, the people that I work with every day to assess opportunity that's coming across our desk. Right? That's one group. And then there's the group of people that do the actual management of the facilities on a day-to-day, week-to-week basis. So those are two separate groups. They both They need to have good systems, processes. They need to have tact. They need to have certain level of interpersonal, capability, a certain level of empathy. Like this is a people business. I liken it to if you owned a Subway restaurant, you need to have a certain level of people skills in order to interface with customers. So if I have a 400 unit facility, there's a facilities manager that works there, plus maybe an assistant, plus a call center, plus these others. They have to have a certain level of interpersonal capacity and ability, and understand that our job is to make sure that the customer is getting what they want. And if they don't know what they want, they need to be able to help them with that. Some people call it upselling, some people call it all these other things. But at the end of the day, if you oversell a customer, you never keep the customer. You can't oversell, right? And so for us, when we're talking to a facility management firm, a third-party manager, we need to get that balance between we need to treat our customers well. They're people just like we are. We want to be treated nice and kindly, and we need them to treat them nice and kindly as well. So it's how do they train? How do they promote? What are they going to fire over? Like that's important. If you're not going to fire one of your employees for lying to one of my customers, that's a problem for me, right? We need to have some process. Now we try not to micromanage them at all, but that's that.
That makes sense. That makes a lot of sense. Stan, what questions do you have?
Yeah, Guy, let me jump in. I know you've moved a long way beyond just owning a self-storage unit. You're now in the business of putting together investment deals where other people can invest in self-storage units. And as I understand, your business, the Momentum Wealth Fund, you buy self-storage units around the United States and different states. I'd be interested just today. I mean, we're having this conversation in January of 2025. What's your current assessment of the state of the market in the self-storage space in the United States generally? And I'm sure that you're going to tell me there are variations depending on what state or town or neighborhood you're in. But what's your take on the market for self-storage units? I've had some of my clients tell me that some of the markets they're in, there's maybe some saturation. But I think you have your ear to the ground on this. What's your take?
Right. So let me give you a little bit of background so you can kind of get a feel for that. Currently, we've got about 4,500 units in our portfolio, which is a lot, but it's not a lot compared to some of the bigger players. And we'll probably get another, 2,000 this year is my guess. The pipeline will probably produce that much. We're in 9 states right now, though we've probably done business in 17, 18 states. And we buy smaller kind of $2 million facilities with 200-300 units, and we build bigger $15 million facilities that are the Class A, that might be branded with a top tier 1 operator type of brand. So we've got the gambit of these items. I'd like you to sort of imagine a grid, and you've got tier 1, tier 2, and tier 3 markets, tertiary, secondary, and primary markets, as well as Class A, B, and C types of facilities. Class C would be dirt, drive up, no climate control, no gate, no lights, no cameras. Class A would be brand new, concrete, all climate control, temperature control, cameras, lights, gates, and all that kind of stuff, right? So older to newer and this. And so it's important. There are some areas of the country that you might consider saturated. Let's just say this is a number in the industry. Across the entire US, there's about 8 square feet of self-storage per person in this country. That's about what it is. And I think it's important to realize that in the 80s, about maybe 2.5–3% of the households used self-storage, where today 11% of the households use self-storage. So even if you had the same amount of people, you would have had a higher demand over time, though we've seen a growth in people and a growth in usage. So that's kind of a factoring of the demand function. Believe it or not, self-storage is extremely localized. We look at it in 3 mile, 5 mile, or 5 minute, 10-minute drive radiuses. So if you're downtown Manhattan, it could take you 5 minutes to drive 1 mile, right? I mean, the drive distance does come into play. If you're in a rural area that maybe's got 20,000 or 30,000 people, it might be 10 miles that people come to use your facility. Turns out people are willing to drive 45 to 60 minutes each way to their job every day, but they want to be within 5 minutes of their self-storage facility. They may go to once or twice a year, right? And so it's important to understand that the mindset of a consumer will determine saturation levels. So there are three main types of consumers. One is business owners. These are contractors, plumbers, electricians, HVAC. They're clothing stores, like a smaller clothing store, a boutique store. They'll use the facility for inventory management, and they'll come and go maybe 1 or 2 times a day to that location. Location is critical to that person. You've got the emotionally attached person. It could be a hoarder that you normally think of, but it could also be, hey, you and 2 of your siblings put your mom into a facility, dad's passed away, you want to store her stuff because you're not going to sell it, so you need to keep it somewhere, and you sold the house to help pay for these things, and there's a life issue going on. And then the third type of customer, there's way more than this, but this third main is this transitory customer. Things are going great, people are buying houses, selling houses, they're moving jobs, this stuff, there's a lot of transition going on, right? A lot going on. So these are the 3 types of customers. So if you're looking at a 5-mile radius in downtown Austin, let's say, you're probably going to be saturated at a level of maybe 15 to 20 square feet per person. And when the interest rates are high and there's not a lot of movement with a certain type of those customers, that's going to be oversaturated because you've got a decrease in demand cycle for one of the customer types, and you've got an oversaturation or supply in the general area. So guess what? We don't buy there, right? We don't have to buy anywhere. We don't have to build anywhere. We're very specific. We probably underwrite maybe 15 deals a week, right? We are on it every day. Now, I don't look at those, right? The team has got a go criteria, no go criteria, yes, no criteria, that kind of stuff.
Okay, let me shift gears and because I have all these questions and we only have so much time to do this. And so I'm going to put on my investor cap. So if I have capital I want to invest,
Right.
There's a world of opportunity, and I could look at real estate versus all kinds of other things. And if I look at real estate, I could look at multifamily, shopping centers, there are 15 different basic categories of real
Right.
estate, self-storage being one of those. So I guess my question is a 2-part question. Why would I deploy into real estate versus other, like the stock market or buying bonds or whatever? And if I'm going to be in real estate, what's the case for self-storage versus the other real estate opportunities I have?
Well, if it were me, I'd tell you 2 years ago, buy NVIDIA, all of it. Put all of your money in NVIDIA, right?
Right.
But so retroactively, we could all, look back. We sort of
hindsight's great, right?
Right. So my mother was a financial planner, right? So she was a CFP. And so that was always one of those things. It's like, how are you going to be able to manage this concept of a risk adjusted return, right? And a lot of people just say, hey, I want to invest because I want a return. I think it's important for any investor to say, well, what kind of risk profile would I put on that? And there's a number of risk profiles that you can choose from. But if an investor doesn't have a risk concept in their brain, then I think they're just throwing darts, hoping it's going to be okay. And hope does seem to be a strategy for a lot of people, but I'm very, very cautious when I talk to people who say, well, why don't I just invest all of my money with you? And I'm like, no, don't do that, right? I don't recommend that ever to anybody, right? That's just not the case. So this concept of risk-adjusted return is very important. The thing I love about self-storage is in and of itself, this asset class is a risk mitigated asset class. Meaning, if everybody in the country starts losing their houses right and left like they did in 2008 and 9, self-storage goes to 100% occupancy. Because it's as people are having trauma and struggles and problems, they need to keep their stuff while they right size their life. Now, we don't celebrate that. I prefer that to never happen. That's just a reality that when things do go bad, this asset class, no matter where, seems to be that risk mitigated in nature. Conversely, when things are going great and people are making all kinds of money, then all three of those customer types are really in influx, right? Got a lot of people buying and selling and moving. You've got a lot of business going on. You've got a lot of these things happening, and self-storage goes to 100%, right? So to speak, right? So the demand on both of those ends of the curve are strong and beneficial to self-storage. So that's what I would say, as opposed to today office, not a great deal unless you're buying it 30% on the dollar and you've got a decade to handle that churn. Super shopping malls have been, they've been good and bad depending on who the operator is. So quick service restaurants like Chipotle or McDonald's, like those have been pretty strong with this recovery coming out. I would say that, multifamily is really taking in the chin right now. Depending on, let's just say this, it's really, really getting hammered in tier 1 areas. In a lot of the primary markets, there was a lot of growth, a lot of development, and the assumptions were they were going to have 3% cap rates, 3.5% cap rates, and now they're trying to refinance at 7%, and it's a bloodbath right now. So I think take all of those into consideration as an investor. Is the operator a good operator? Is the asset class like the asset class you want to be in? I mean, I love residential because somebody else buys you a house. I mean, how bad is that? Like, that's a great thing, right? And people need to live somewhere. We don't let them live in our self-storage facilities. So I'm not down on those asset classes. Yeah, I hope that answers the question.
Yeah, it does. So pursuing that a bit further, and I know, future return is, past performance is not a guarantee of future performance, but could you give us sort of a general idea of what kind of returns that you've experienced in the properties that you've been in? I know, and I'm sure that's going to vary from property to property a good bit.
Yeah. So for the person who doesn't understand net present value, IRR, discounted cash flows, like NOI, like they don't understand these things, we just say, listen, we want to double your money in 5 years, right? Invest $100,000 today. At the end of 5 years, you'll have $200,000. Some of that comes from cash flow from operations. Some of it may come from a refinance function, and some of it's going to come from the sale, right? Like that's in general what the concept is. The IRR is going to run from 16, 17 to maybe 22. Equity multiples are that 2.0, 2.1 equity multiple. Some of them have existing cash flows. Like we've got a deal right now that's paying currently a 6 pref. So the cash flows from operations are paying a 6 pref. We typically have anywhere from a 6 to 8 pref in our projects where we'll accrue that non-compounding. And then as cash flow comes in, that pref gets caught back up before we are able to take any of our money out. I'm a big proponent of making sure that as the operator, I have more money to collect after you could collect your money, right? Meaning if I collect all my money first and then you collect your money, then you're depending on me to being a nice guy and focused, and I am. But I find that if I incentivize our entire team and this structurally, that we make money after the investors make money or alongside when investors make money, then that keeps everybody's head right-minded towards treating our investors first before we treat ourselves.
So I want to follow up on that and just ask you to, if you could briefly summarize the structure of the Momentum Wealth Fund. How does that work?
Sure.
Yeah. What's the structure of the fund?
So a lot of people think of funds as then they're closed-ended or open-ended or evergreen or, specific to some things. And this is a customizable fund, which means that we can continue to raise money. We raise money generically so that we can apply them directly to deals. So as we're finding deals and the pipeline's coming through and people are saying, okay, here's the deals that are available, it's incumbent upon us to help the investor understand which deal is what. And then the investor invests in the fund and then they choose to nominate or allocate their money specific to each project. So if an investor says, look, I want to put $300,000 in, we'll do $100,000 to each of these projects, boom, 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 then they've got $100,000 in each of the projects. Each project may have a different return profile, may have a different risk profile. If it's construction, it's got a slightly higher risk profile than it does if it's an existing cash flowing property, right? It's just a different type of thing. Once the year end comes around, all of that rolls up and they get 1K1. So since we control all of the accounting, meaning the bookkeeping portion of it, and then the CPAs do all of the year end, making sure everything's done right, and it rolls up to the CPAs who handle the fund accounting. We are responsible to make sure that all that stuff happens and it gets done timely and it gets done by March 15th so everyone can have the K1s to do what they need to do. So it's customizable in that they're able to determine if they want to be in a project or not, right? They can choose to be in multiple projects or only one. Like I said before, some investors don't want to be in certain states. They just don't want to be in certain states.
So what does the investor get? Is this an LLC or limited partnership they have an interest in? Yeah.
So what ends up happening is we create a single purpose entity that owns the facility, right? And so a good example is we're just buying 13 facilities here in Iowa. We're putting a single purpose entity that owns each one and a holding company that owns all 13. They're all disregarded. They all flow into one. It's easier to have one taxes, but if we sell, we can sell them off one at a time.
Right.
Because they have their own bookkeeping, checking accounts, and all that kind of stuff.
Right. Yeah. Interesting. So Katie Beth's going to ask you some more in a second about how people contact you, but I mean, this does seem to be an area that people are interested in. I think for me, real estate investing always made sense because you were right about investing in NVIDIA, but that would have required you to explain this artificial intelligence thing. And I'd have to get my head around that. But, when you tell me I'm buying into a self-storage unit, I can drive over there and walk around in it and open doors and see what it looks like and like feel of it, right? It's like I can see if there are other customers coming in. It's like it's a practical reality for me to kind of like I can get my head around it. So
Sure.
I really see the appeal for sure.
There's one other thing that we do, and this may or may not change with Trump now being reelected. The cost segregation analysis that accelerates the depreciation gets filtered through. So losses can get filtered through, even though it's an artificial loss, right? Through accounting. It's an accounting. It's an accounting loss. It's not a cash loss. It's an accounting loss, right? And that's been great for our investors and me personally, especially when it was 100%, then 80, and then 60, and then now 40. That's one of those things that can offset passive gains from investors.
Yeah, until you sell, and then you have to recapture that.
Right. And so depending on where they're at in their tax bracket, recapture is typically 25%.
Yeah.
Right. So if they're at a 37.5% tax bracket and they're recapturing at 25%, they're like, let's do that all day long.
Yeah, that's a good arbitrage for sure. Yeah.
Yeah.
Good. Those are all my questions, KB. So
That's perfect. No, you answered all of mine too. Guy, thank you so much for taking the time to I really learned a lot just explaining all of these different options and all of the reasons. You really make a strong case for investing in this type of property. And I don't know that we've ever really talked to anybody or I've ever had anybody really break down all of the different types of property investing. So that was really helpful. I know for sure I'm not the person who wants to do the type of property where I receive phone calls on Thanksgiving Day. So, but there are those people out there. Having a house paid for, owning a second home and having somebody else pay the mortgage also sounds great. So it's very interesting and just very helpful sort of across the board for Stan, for myself, and for our listeners as well. So thank you. And for all of our listeners, we want to thank you for listening to the Legacy Leaders podcast. Our guest today was Guy Varble, and to connect with Guy, you can find him on LinkedIn, which we will link in the show notes for you to make it easy. So, Guy, thank you again for just taking time to share all of your wisdom and knowledge. We really enjoyed it.
Thank you very much for having me, and have a great, great day.
All right.
You've been listening to the Legacy Leaders podcast with Katie Beth Hand and Stan Miller. For more information on them and the show, please visit pinnaclelegacylaw.com. If you like what you've learned today, do share the program with your friends and subscribe wherever podcasts are found.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.